Hi everyone. In our last episode, we discussed debt funds. Today we'll be focusing on hybrid funds. Hybrid funds explained with analogy. Think of it preparing a recipe for a perfect dish. You can't just rely on one ingredient. Each one has a specific role. For example, to make a delicious soup, you need a mix of vegetables, spices, broth, and seasoning. If you use only one, it won't give you the full flavor you're looking for. Similarly, in investing, combining different asset classes like equity, debt, and gold helps create a balanced portfolio that provides the right mix of growth, stability, and security tailored to your financial goals. In the same way, every asset classes, equity, gold, debt has its own merits. So it's only ideal to create an ideal portfolio by combining these three asset classes to get the desired results. What are hybrid funds? Let's consider an individual looking to invest for a period of 3 to 4 years. What investment option would be available to someone with this time frame in mind? The person could invest in fixed deposits or maybe in equity. Now, equity has a potential to give you good returns in the long term, while debt helps you giving stable returns. The challenge here is that the interest offered by fixed deposit is relatively lower and may not beat the inflation. At the same time, investing in equity for a tenure of 3 to 4 years could be quite risky. So, the solution in this case is hybrid funds. Hybrid funds, as the name suggests, are a combination of debt and equity. In this particular case, you can accept returns slightly better than fixed deposit interest with lower risk compared to equities. Hybrid funds are a combination of 2 or 3 asset classes, but the most common hybrid funds that we see are the ones which combine debt and equity. Why choose hybrid funds? Hybrid funds have versatile investment option that offers a balanced approach to managing risk and reward. They combine equity and fixed income instruments in varying proportions, making them suitable for investors seeking stability and growth. Unlike equity funds, which can be volatile, or fixed income funds, which may have limited growth potential, hybrid funds strike a middle ground. One of the key advantages of hybrid fund is their ability to rebalance automatically. When equity markets are booming, the fund reduces its exposure to equities, locking in profits. Conversely, during market downturns, it increases equity allocation to take advantage of lower price. This disciplined approach eliminates the need for investor to time the market and ensures the optimal asset allocation. Hybrid funds also cater to diverse investor needs. For the first time or the cautious investor, they provide exposure to equity without the significant volatility of pure equity funds. For seasoned investor, they offer a stable, tax-efficient way to diversify portfolios. Additionally, hybrid funds are ideal for navigating market uncertainties, as they reduce the emotional aspect of investing by automatically adjust to market conditions. Type of hybrid funds. Now let's talk about the key types of hybrid funds. Conservative hybrid funds, portfolio allocation and risk. Conservative hybrid funds invest a bigger chunk of the portfolio in debt instruments compared to equity. If you look at a conservative hybrid fund, about 75% to 90% of the portfolio or the net assets would be invested in debt instrument, while 10% to 25% would be invested in equity. Ideal investment horizon and expected returns. The ideal time horizon for these funds is 2 to 4 years. Given sufficient time, debt hybrid funds have the potential to outperform debt instruments and fixed deposit returns. You could accept returns that are FT plus 2% to 3%. Aggressive hybrid funds, equity and debt allocation. As the name suggests, aggressive hybrid funds are the most aggressive in nature. These funds allocate 65% to 80% to equity and 20% to 35% to debt. Volatility and investment horizon. Since these funds are equally heavy, they tend to be more volatile. If the markets go down, these funds tend to underperform. The ideal time horizon for equity hybrid funds is 4 to 6 years. These funds have the potential to give returns closer to equity mutual funds. Balanced advantage funds. Dynamic allocation based on market condition. These funds have a flexible allocation between debt and equity, which can range from 0% to 100% in either asset class depending on market conditions. Flexibility and investment horizon. These funds sell when the markets are going up and buy when the markets are going down. The ideal time horizon for the balanced advantage funds would be anywhere between 3 to 6 years. How to choose the best hybrid funds? Choosing the best hybrid fund depends on your investment goals, risk tolerance, and time horizon. If you're a beginner or looking for a relatively stable way to enter equity markets, aggressive hybrid funds are a good option. These funds invest 75% in equity and 25% in debt, offering growth potential with some stability. For medium-term goals or investors seeking more flexibility, balanced advantage funds work well. They dynamically adjust equity and debt allocation based on the market condition, although they rely on the fund manager's ability to make the right calls. Finally, multi-asset funds diversify further by including gold or other commodities, but they are heavily influenced by gold's performance, which may not suit everyone. Each type of fund serves a specific purpose, so understanding your needs and risk appetite will help you pick the right one for your portfolio. Tax benefits of hybrid funds. A very important advantage of equity hybrid funds and dynamic asset allocation funds is the tax advantage. Both these funds are categorized as equity funds even though they are hybrid in nature. An equity fund has to have at least 65% of portfolio in equity instruments throughout the year. And that's exactly what these hybrid funds do. Since they hold at least 65% of the portfolio in equity instruments, they categorized under equity taxation. Hybrid funds for retired investors. For retired investors, equity hybrids funds and balanced advantage funds could be the good options. They can invest for a period of 3 to 4 years and start the withdrawal process through systematic withdrawal plans. These funds would definitely outperform debt instruments and beat inflation in the long run. Other hybrid fund categories. Now, some of the other categories of funds under the hybrid fund category include the balanced funds, multi-asset funds, and arbitrage funds. Let's discuss this briefly. Balanced funds, equity allocation and tax implication. These funds are the combination of debt and equity, but the maximum allocation is equity can only be 60%. This means they lose the equity taxation benefit. Multi-asset funds, combining equity, gold, and debt. These funds invest in 3 different assets, equity, gold, and debt. The weightage of these asset classes varies from fund house to fund house. Typically, these funds are equity heavy with small allocation to debt and gold. Arbitrage funds. Arbitrage funds aim to generate risk-free returns by buying and selling the same asset in different markets. The ideal time horizon for these funds in 1 year. Returns are comparable to liquid funds but with equity taxation. Conclusion and key takeaways. So to sum up, investing in hybrid funds is like getting the best of both debt and equity. But debt provides stability and equity offers capital appreciation. Compared to equity mutual funds, hybrid funds are definitely lower in volatility. So, if you're looking at portfolio with good asset allocation, capital appreciation and lower risk, hybrid funds are the way to go. Just like in concrete mixture, example, where different mixtures and variants produce different outcomes. Different combination of debt and equity could lead to different outcomes. Based on your investment objectives, you should be able to select the right hybrid fund for yourself.
Stack Wealth is a new age investment management company that helps you take your wealth to new heights. Our team consists of experts with 25 plus years of experience managing investments for more than 1 lakh investors. Our team of experts help you curate a personalized mutual fund portfolio based on your goals and risk tolerance. They help you decide your asset allocation. They also help you identify high-performing sectors to help you generate additional returns. And finally, we help you manage and monitor your investments in real time. First, download the Stack Wealth app from the Play Store or App Store and complete your sign-up by entering your mobile number and email ID. Now you can explore the app, get your personalized mutual fund portfolio, or browse our various investment opportunities. To start investing, you have to complete your KYC. Once your KYC is completed, you can start investing in your personalized mutual fund portfolio or explore our expert curated investment opportunities. If you're not sure where to begin, your dedicated wealth manager will help you. Now you can start an SIP or make a one-time investment. Remember, you can always pause your SIP anytime and edit the SIP amount if you want to increase or decrease it. Finally, you can sit back, relax, because our wealth team will rebalance your portfolio based on shifting market conditions, identify and recommend new investment opportunities, give you monthly portfolio reports so you know exactly how your portfolio is performing. If you found this video helpful, don't forget to hit that like button, subscribe to our channel, and tap the bell icon to stay notified, because we are making finance and investing as simple as possible for everyone. Thank you for watching, and goodbye.